Thank you very much. Let me welcome you to MathZone African Motives, whereby I want us to do a revision, which is in relation to our accounting grade 10, which as well will help us for the upcoming exams. So make sure that you are going to share with those who are interested, and make sure that you are going to hit the subscription button. So without wasting much time, let us go straight to the question one. Let us go straight to the question one, which is accounting concepts and analysis of transaction. Accounting concepts and analysis of transactions. This is what we are going to be looking at. So the question reads as follows: 1.1. Match the following column, match the information in column A to the term in column B. Write only letter A to G in your answer book. That is that, as we know. So as we are told that we are going to match the information in column A to term in column B. So without wasting much time, let us just do as we are instructed to do. So 1.1.1, it says the management of a business should treat employees equally regardless of their position. This is our key words. Should treat what? Employees equally regardless of their position. So now we want to know the correct answer, which is C. Correct answer is C. Because we are talking about the management must be fair. So the correct answer is C. So we are talking about the fairness that the management must be. So 1.1.2, assets that are convertible into cash within a period of 12 months. That's when we're talking about the current assets. The current assets are the ones that we can convert them into cash within what? A period of 12 months, within a year. So the correct answer there is D. That is current assets. Current assets. Now we're moving on to 1.13, which says commonly accepted guidelines that are followed when financial records are prepared for reporting. So the correct answer is going to be G. That is, we follow this guideline, which is GAAP. That is a guideline for the that you need to follow when you're doing our financial records, more especially when you're doing when you're preparing for the reporting. So the correct answer is G. Correct answer is G. One can ask, what is this GAAP in full? So GAAP in full stands for Generally Accepted Accounting Principle. Generally Accepted Accounting Principle. So it is a set of rules or standard or procedures that accountants follow when preparing financial statements and when reporting financial information. Hope you get it. Those are the rules or standards as well as procedures that accountants have to follow when preparing financial statements, and as well when they are reporting financial information. So the key aspects of GAAP is about consistency, transparency, accuracy. With consistency, it ensures that financial statements are presented consistently, making it easier to compare and analyze financial data. That's about consistency. But with transparency, it promotes transparency by requiring companies to disclose relevant financial information. With accuracy, it aims to ensure that financial statements are accurately reflect the company's financial position and performance. So that is the GAAP that we are talking about. So now we are moving on to 1.14. 1.14 says a summary of balances and totals extracted from all the ledger accounts of business. So that one is the trial balance. The trial balance. The correct answer is E. An example of non-current assets, as you know, is what? Fixed deposit. The correct answer is B. So this is how you were to answer the multiple dimension question. So we do have our answer book. We have our answer book. Here is our answer book. So as we have said, 1.11, the correct answer is C. 1.12 is D. 1.13 is G when we're talking about gap. And then 1.14 is E. And 1.15 is B. So this is how we were to answer this question, 1.1. Now we are coming to 1.2. We are coming to 1.2, which read as follows. The transactions below appeared in the books of Waterkloof Traders for the month of March 2023. Then Waterkloof Traders used 8% markup on cost of price required. Use the information of Waterkloof Traders to flow the impact of each transaction on the accounting equation for March 2023. So that is what we are asked to do. So we are going to do the general ledger, whereby now we are going to do the accounting equation, where we are going to know which accounts are going to be credited, account debited, the effect of that on the of each transaction on the accounting equation. So without wasting much time, let's go straight to the transactions. The first transaction reads as follows. First transaction reads as follows. Bought goods on credit from AB traders. You bought goods on credit from AB traders for 10,800 less 10% rate discount. So now we want to know the accounts that you are going to debit and the accounts to be credited. So you bought goods on credit from AB traders. So it means you are going to have what? Trade in stock as well as creditors on draw. Because we bought the goods, it means that is a stock. We bought a stock on credit from AB traders. So our AB traders now is our creditors. So these are the two transactions. So now we want to know now which account is going to be debited and which account is going to be credited. Very important to take note of. And then the effect of transaction on accounting. So as we are told that those goods were bought from AB traders with less 10% trade discount. So we are going to say 10% multiplied by 10,800. Multiply by 10,800. And then it will give us what? 1,008. It will give us 1,008. Let me write it very well. So it will give us 1,008. That is that. So we are going to say 10,800 minus 10,800. we are going to say this much minus 10,800, which is going to give us 9,720. That is the amount that we are going to record. That is the amount that we are going to record. So now let's see how we are going to record it. So here we are under our answer book. So we want to know the account debited. So the account debited is going to be a trading stock. Trading stock, because we bought a stock. So it means our stock is increased. So when you increase our stock, when you receive the stock, it's going to go into the debit side. So the account credited is going to be creditors control, because they are the ones, creditors are the ones who are releasing the stock. Creditors control, because now the stock is being taken out of the suppliers. So now we want to know the accounting equation now. So we are going to buy a stock. So it means we are going to increase our stock. Our assets are going to be increased. So we are going to say plus 9,720 plus 9,720. So also our liabilities are going to increase. Our liabilities are going to increase by 9,720 because we bought the stock on credit. So that is that. So now we move on to another question. So the other question says paid 450 out of the petty cash. Paid 450 out of petty cash to parcels are used for goods delivered to a debtor Don Van. So the amount must be debited to his account. So it means we have a petty cash. We paid that 450 from our petty cash to these parcels. So what does that mean? So it means we are going to do what? We are going to debit a debtor's control, because these goods are delivered to this debtor. So it means our debtor's control as an assets are going to be debited. And then also we are going to credit what? The petty cash, because we are taking money out of what? Out of our petty cash. So now we are going to our answer book now. We are now going to our answer book. Here we are. Already petty cash we are given it. So it means now we are to debit what? Debtor's control. Debtor's control. Because the debtor, our debtor is the one who's going to, the goods are delivered to him. They don't vend. So the effect on accounting equation now, that is that the petty cash is a cash, it is an asset. Also the debtors falls under the assets. So both two of our accounts are the assets. So now we are going to have plus 450 as well as minus 450. How so? It's because our assets are going to be increased. Our assets are going to be increased by 440 because of what? The debtor's control, debited. Also, because we are going to pay out that 450 from what? Petty cash. It means now our assets are going to be decreased by 450, because both debtors and petty cash are our assets. They are both our current assets. Hope it makes sense. So now we are moving on to transaction 16. Now we are on the transaction that took place on the 16th, which reads as follows: sold goods on credit to K. Moss for 4,500 and issued an invoice. So you sold the goods on credit to K. Moss. To K. Moss 4,500 and issued an invoice. So we are going to have what on the 16th? Debtors control. Who is our debtor? Is a K. Moss. So our debtors control is going to be on the debit side because our debtor is going to receive what? It's going to receive what? The goods that we are selling to him on credit. So that is why we are going to debit our debtors control. And then credit our sales because we are selling the goods. We are taking out the goods to this debtor. So that is that. So now let's see how we are going to record it. Let's see how we are going to record it. So here we are on our general ledger. So already our debtors in our answer book already has been debited for us. So here we are going to write sales because we sold the goods on credit to this debtor. So we're going to have sales. So now let us see the effect on our accounting equation. So the effect is going to be plus 4,500 plus 4,500 because we are adding what? Our assets are going to be increased because of what? Debtors. It's our debtor. So it means on the debtor side, the assets are going to be increased. And also our owner's equity is going to increase by 4,500. Our owner's equity is going to be increased because now we are selling those goods on credit to this debtor. It means in return we are going to get what? The revenues, and that revenues are going to increase our owner's equity. So that is that. But we do have what? Cost of sales. We cannot sell the goods and then do not know how much it cost us. How much it cost us to sell those goods. So we need to know what? The cost of sales. So cost of sales, normally it is always debited. Cost of sales. Because it is an expense. It cost us. We incurred expenses for us to sell those goods because we bought those goods or we manufactured those goods. So we do incur what? The expenses. That is what. So we are also going to have what? Trading stock. Trading stock because the sales, we were selling what? We were selling a stock. We want to know how much it cost us to sell that stock. So it means now we are taking out the stock. So like we were told that we sold the stock on credit to our debtor. So now let us go back to the information now. As we were told that Waterkloof Traders uses how much? 80% markup on cost price. That is a very important information to take note of now. It uses 80% so the 80% on a markup on cost price. So that is that. So if it is like that now on the 16th, we are to make sure that now we are going to calculate the selling price with what? With markup. So we can use the formula to do that, whereby we are going to say selling price. We are going to say selling price is equal to cost price is equal to cost price multiply by 1 plus markup. 1 plus markup percentage. 1 plus markup percentage. That is how we are going to do it, so that we can know how much is our cost price. So meaning we are going to say so one can ask, where is this one coming from? So the one is represent the original cost price, which is 100% of the cost price. We produce the products, or we manufacture the products at 100% cost price. So that is that. So it simply says now we are going to add it with what? The 8% of the cost price, that percentage. So meaning we're going to say we are going to say 1 plus 0.8. That is that. 1 plus 0.8. So the 0.8 is what? The 80% of what? Of markup. This is our markup. So this is one that represents what? The original cost price. So when you add this and this, you're going to get 1.8. You're going to get 1.8, which is our multiplier to calculate what? The selling price. So 1.8 is what? Our multiplier to calculate what? The selling price. How much? How much was what? How much did we sell our goods? Is 4.5. 4,500 multiplied by 1.8, which is the cost price now. So that is that. 4.5 is equal to cost price times 1.8. So to make it simple, and let's just do it this way. So here we have that multiplier. So to find the cost price, we're going to divide 4.5 by 1.8. We're going to say 4.5, 4,500 divided by 1.8. So now we'll get what? The cost price, which is 2,500. So that is that. That is how easy we are to calculate what? The cost price. Take note of that. We are going to have one which represent the original cost price plus the markup that we are given, which is what? The 80%. Then we'll get what? We will be able to get what? Our multiplier now. So we are going to say our selling price 4,500 divided by our multiplier 1.8. Then we'll get what? We'll get our cost price. That is how we are to calculate the cost price. So now we are going straight to our answer book. We're going straight to our answer book. So here we are on our answer book. Cost of sales, debited, credited what? Trading store. So we have what? 2.5. 2,500. And it's going to be negative because of it's our assets. So it's assets, as you know, the cost of sales. Then we have 2.5 again on owner's equity. So it is negative 2.5 because, or minus 2.5 because now this is going to affect our cash because it's going to cost us 2.5 to sell our stock. So that is going to reduce our cash, which falls under the assets. Also, our revenues are going to be affected, whereby now they are going to decrease by 2.5, our owner's equity. So hope we are together. Now we are moving on to the transaction that took place on the 19th now. To a transaction that took place on the 19th. Here we are on the 19th. So on the 19th, we are told a printer bought on credit for office use 2,400 from XY Printing in February 2023 and had a defect which was faulty, and after consultation with XY Printing, the printer was returned to them. No transaction was recorded. No transaction was recorded. So it means you're going to have what? Creditors control as well as the equipment. This was returned to the creditors. This printer, this equipment of us, which is a printer, it was returned to creditors. So the creditors are going to receive it. That is where we are going to debit what? Creditors control. And then we are going to credit what? The equipment, because we are returning it back to the suppliers. So now let's now put it in record. So here is our creditors control, or it's already debited. Now we are to credit equipment, which is our printer. Credit equipment of how much? 2,400. 2,400 minus 2,400 minus 2,400. So this is how it is. You know very well that the equipment is an asset, falls under non-current assets. So as we return it to our creditors, it means now we are going to reduce our assets. That is why we have what? Minus 2,400. Also, as we know, now it's going to affect our liability now. So it means now our liabilities now are going to be reduced by 2,400. Not increased, but reduced by 2,400, because we are returning back what? That equipment that we bought on credit. So it means now our liabilities now are going to decrease by 2.4, as we are returning what? Back what? The equipment that is faulty. So that is that. Hope it makes sense to you. Now we are moving on to the transaction of which took place on the 21st. Which took place on the 21st. Here we are on the 21st. A credit note of 1.2 was issued to KMOS for returns of some of the goods bought on 16 March. And the goods were not returned to the storeroom as they were totally damaged. So now, as we are told that the goods were returned, some of the goods were returned. So it means we are going to have what you call debtors allowance. We're going to have what? Debtors allowance. So its debtors allowance is debited. We are going to debit our debtors allowance. as our debtors allowance are sales returns. So they are debited. We're going to debit them with 1.2 because now they are going to they are expenses. So they are expenses. Our debtors allowances are what? Expenses. So we have to make sure that we are going to debit them, and they are going to decrease our owner's equity. Those sales returns are going to affect our owner's equity. So let us see how we are going to record them. So we are going to have what? Debtors allowance. Debtors allowance is debited as it is an expense because those are the sales returns. They return back to us as a business. And then we are going to credit what? Debtors control. Because debtors are the ones who are retaining what? Who are retaining the goods to us. Debtors control. So now we are going to have what? Minus 1.2 minus 1.2. Minus 1.22 in debt in under assets because now we are retaining what? We are retaining the goods to back to the business. So debtors are retaining the goods back to us as business. So on the debtors, it means now on the assets, now the assets are going to be reduced because there are goods that are going to go out back to us. So the debtor side is going to decrease by 1.2. So them retaining these goods, which are even totally damaged, that is going to decrease our owner's equity. So that is error there. We wanted to write it on under owner's equity, not liability. Owner's equity, 1,200 goes under owner's equity. So that means what? Our owner's equity is going to be affected. Our revenues are going to be reduced because of now those goods are returned back to us. So that is that. So now let's move on to the transaction of 20, which took place on the 25th. Which took place on the 25th. So here we are on the 25th. Received 3,400 from Arbond, who's a debtor in settlement of her account of 3,500. We received this much. But the settlement account is what? 3,500. That is that. So we are going to say we are going to receive that by bank. We're going to receive that by bank. So meaning we're going to debit our bank as you're going to receive money from debtors. So we're going to credit what? Debtors as they are going to pay. They're going to settle the amount. So on the accounting equation, we are going to have what? Plus 3.4. Plus 3.4 as well as minus 3.4. Let's see how we are going to record it. Let's see how we are going to record it, and then we'll just give clarification on it. Already we have bank as we are paid by the bank. Now we created our data as is the debtors control as we are going to be paid by data. Debtors control. Debtors control. So we are going to have, say, plus 3,400 as well as minus 3,400. So that is that. So now let's explain this plus and minus 3.4. You remember that our settlement account was what? 3.5, but we were paid this 3.4 by bank, which we debited. So it means bank as well as debtors, they are what? They are our assets. So it means you're going to get 3.4, that is going to increase our assets. On the side of debtors that who are going to pay us 3.4, it means there is going to be what? Minus 3.4. That is why it is plus 3.4 and minus 3.4. It means both bank, which we are going to receive the money by, as well as debtors who are going to pay us, they are both what? Our assets, our current assets. So it means our current assets, we are going to have plus 3.4 as we're going to receive that money. And then on the debtors side is good, there is going to be reduced by 3.4. So that is why we have plus 3.4 and minus 3.4. So we also have what? A discount allowed. Remember, we are supposed to be paid what? 3.5, but now we are paid what? 3.4. So it means you're going to have a discount allowed. Discount allowed. So it's an expense as we have allowed the discount to our debtors. So we are going to debit it and credit toward debtors and credit toward debtors control. Debit debtors control. So we are going to have what? Minus 100 as well as minus 100 on the equity side, owner's equity side. So it means because we allowed the discount of 100, that is going to affect our what? That is going to affect our cash, our money, our assets, as we are now to part ways with this 100, which is a discount that we give to our debtors. So that is going to affect our revenues. That is why we have minus 100. So owner's equity is going to be affected. Now let's move on to transaction which took place on the 31st. And then you hear it what it says. On the 31st, we are told that a loan repayment of 44,000 to Investec Bank included an interest of 10%, 10% per annum for the 1 year. Funds were paid via EFT. Funds were paid via EFT. Now we are talking about the loan now. Whenever we are talking about the loan, which we are to pay, it is an expense. So it means you're going to debit loan and credit bank. Because the loan repayment we are paying. So we are always paying, we're going to pay by cash. Okay. So now we're going to say debit loan, credit what? Bank. That is that. How much is that? Now it's very important now that we are going to make a short calculation of that. So we are going to say 10% that we are told that it included an interest of 10% per annum. So we're going to say 10% of our 44,000, which is this one. Then it will give us 4,400. So now we're going to say 44,000 minus this interest now, so that we know how much we're going to pay without or excluding the interest. So for 44,000 minus this interest now, it will give us 39,600. So now let's see how we are going to record it in our answer book. In our answer book. So here we are in our answer book. We are going to have loan, debited, and then we are going to pay loan through what? Through bank, through cash. So we have said it's how much? 39,600. 39,600. So we're going to say minus. We're going to say, because you're going to, for us to pay loan, it means you're going to pay it through the cash. So it means our assets are going to be reduced by this much. Also, then we come to our liabilities now. Our liabilities now are going to decrease by 39,600. Our liabilities are going to be decreased now because we are paying this much now. So we are paying this much. So it means our liabilities are going to decrease by 39,600. So now we have interest on loan. Interest on loan of how much? Of 4,400. We have interest on loan debited, and then we have what? Bank credited. So because of we are to pay the interest, as you know, so it means that is going to as well reduce our assets by 4,400. 4,400. So that is also going to affect our revenues on the owner's equity side by 4,400. So this is how we were to answer this question 1.2. This is how we were to answer this question 1.2. Now we are moving on to question 2. Now we are moving on to question 2. Question 2. So here is our question 2. The question 2 is about what? General. It's about general. So they say an information for December 2022 presented below is taken from the books of the Adventure Apparel. Required, record the transaction in the journal for December 2022 and close of the journal. Narrations are not required, so you're not to narrate. So information, here is the information, whereby now we're going to look at these transactions. Whereby we're going to look at these transactions. Transactions on 31st December 2022. That is that. So without wasting much time, it reads as follows. A debtor, C Stokes, who owns 2,400 was declared insolvent, meaning as a bad debt. So his estate paid 40 cents in rent. So this has been recorded in the books of the business. So the remainder must be written off as a irrecoverable. So the remainder must be written as a irrecoverable. So as we are told like that, we are to make sure that the remainder is going to be written off as a recoverable. So it means we are to write off irrecoverable balance of this person. So what we are going to say, we are going to say the amount that the amount owed is 2,400. That is the amount owed 2,400. That is the amount owed. Amount owed 2. And then 2.4 received. Because that is what we are saying. A debtor who owes 2,004 was declared insolvent. So we are going to say 2.4 multiplied by 40%. That is why now we are going to convert that to 0.4 cents to percentage now. So it means when you multiply by 2.4 by 40%, we are going to get what? 960. We are going to get what? 960, which is received already. This one, it is received already. This one, it is received already. So we want to know the remaining. We want to know the remaining, which we are to write it off. Which we are to write it off. So it means we're going to say 2,400 minus 960. Then it will give us what? We are going to say 2,400 minus 960. Then it will give us 1,440. Hope we are together. Hope we are together and we do understand this transaction, whereby a debtor Stokes owns what? 2,400 and was declared insolvent. His estate paid what? Paid 40 cents in the rent. He paid what? 40 cents in the rent. And this has been recorded in the books of the business. The remainder we are to write it off. So that is why we have said we are going to multiply what? 2,400 minus 0.4, which is in percentage is 40%. Then it will give us 960. So the 960, we said it is received already. So we want to know the one that we are to write it off as a bad debts. So that is where we are going to say 2,400 minus 960, then it will give us 1,440, which must be written off as a bad debt. So the explanation of this is that the unpaid portion of his debt is now considered irrecoverable, which is going to reduce what? Accounts receivable. Hope we do understand. So now we are to go and record it under general journal. As we are told that we are to record it under general journal. Under general journal. So here we are under our general journal, where we are to record it. So we are going to have what? We are going to have bad debts. We're going to have bad debts and C Stokes. And have what? C Stokes. So now we are going to say debit 1,440 versus debit 1,440, and then we are going to credit what? C Stoke by 1,400 or 1,440, which we know very well that it goes under debtors control. It goes under debtors control in the credit side. 1,440. So that is how we are going to record it. Hope we are together on this one. So by recording them like this, whereby we are debiting bad debts expense, we are increasing what? The expenses. We are increasing the expenses. But when we credit our data, C Stokes, it means we are saying we are decreasing our assets, because we are no longer going to receive this 1,440. So that is that. By crediting debtors control, you are reducing debtors balance, which reflects the amount that is no longer expected but to be collected. Hope it is clear. So now we are moving on. to our question 2. To the second transaction. Transfer a debit balance of 280 in the account of M. Maxwell from the debtor's ledger to his account in the creditor's ledger. M. Maxwell is both a customer, very important, this one, and the supplier to the adventure of the apparel. So it means we are going to have M. Maxwell as a creditor. This is what the transaction tells us. And then we are going to have him again as a debtor. That is that. So we are going to debit him as a creditor, and then we are going to credit him as our debtor. So we are going to record it this way. Here we are. So we are going to have M Maxwell, and then have M Maxwell again. So here we are going to say 280, and then also 280, and also 280, which now we are going to have it on the debtors control. Debtors control. Well, because we were told that on the same transaction that Maxwell is both creditor and the debtor in the same transaction. So we are trying to offset what the balance is now. So it means now we are going to debit what? Maxwell as what? As a creditor. Here we are debiting him as what? As a creditor. Here as what? Here we are credit. When we are debiting him as a creditor, here we are debiting, we are crediting him as a debtor. So here we are going to debit Maxwell as a creditor. Here we are going to credit him as a debtor. So why do we do that? That is very important. It means when we debit him here as a creditor, it means we are decreasing his liabilities. That is that. But when we credit a debtor here, our Maxwell, we are decreasing what? The assets. That's what it means. Thank you. Now let's move on. Let's move on to another transaction. Here we are. So here we are told that the owner took trading stock at a cost price of 1,200 and the transaction was not recorded yet. So it means now we're going to have what? Drawings. We are going to debit our drawings and credit what? The trading stock. Because we took the stock, which means we debit while we are receiving the stock, and then we credit the trading stock because the stock was taken out of the business. So it's easy as like that. So this is how we are going to record it. We are going to say, drawings of how much? 1.2. 1,200. And then we have what? Trading stock. We have trading stock of how much? 1.2 on the credit side, as we are taking out the stock out. So now we are moving on to another transaction. We are moving on to another transaction where it says the business received amount of 35,000 from Absa Bank via EFT for a fixed deposit matured on 30th December 2022. Included in the amount is interest fixed deposit of 3,000. So the total amount of 35,000 has been credited to the fixed deposit account. Correct the error. Correct the error. So that is that whereby we are going to have a fixed deposit of 3,000. We are going to have a fixed deposit of 3,000 that we are to debit it as you're going to receive it. So, all right. What we are saying with this transaction is that we are told that the Absa received what? The business received the amount of 35,000 from Absa. We received this much from Absa, 35,000. So it means that 32,000 is the fixed deposit principal. Is the fixed deposit principal, the original investment. Why? Because why are we saying that? Where do we get 32? Maybe someone can say that 35,000. Now we minus the 3,000 to give us 32,000. This is this 32 is our what? It's our original investment. It's our original investment. It's the fixed deposit principal. So the 3,000, this one, is what? It's an interest earned. So this is incorrect because, so the error, no, let's come to the error that we have to correct. The error, the full 35,000 was credited to fixed deposit account, which is the error. So the error is that this 35,000 was credited to the fixed deposit account. So that is the error. So this is incorrect because 32,000, which is the principal amount that we have talked about, should reduce the fixed deposit. Should reduce what? The fixed deposit. So the 3,000 should go to interest income. This one should go into interest what? Income. So now let us correct the entry. So for us to correct the entry, we need to reinvest the incorrect credit of 3,000 in fixed deposit. We need to reverse the incorrect credit of 3,000 in fixed deposit. So this is, we are going to record the 3,000 to interest income. So that is what it is needed. Whereby now we are going to record it this way. Whereby now we are going to record it this way. Here we are under our general journal. So we are going to say fixed deposit, Absa. Fixed deposit, which is we're talking about Absa, of how much? 3,000. 3,000 debited, and then we're going to credit what? Interest on fixed deposit. Interest on fixed deposit. which we are to credit it, which is 3,000. So that is that. Now we are moving on to another transaction. Now we are moving on to another transaction. So the other transaction says goods returned by J Yards, who is our data, as per credit note for 280 was incorrectly posted to the account of J Young as a data. That's what we are told there. As a data. So with this transaction, it shows that there is an error. There is an error that took place here, and then we are to make sure that you're going to correct that error. As the goods returned by JS of the 208 were incorrectly posted to J Young's account. So for us to correct it, we are to debit J Young. We are to debit J Young with 208. This refers the wrong credit made to J Young's account, restoring his balance. And then credit J Yates with 208. That is correctly reducing J Yates' balance. He returned the goods. So that is how we are going to record it. Now we move on. So we are going to say J Young. Going to say J Young. We debit J Young with 280. We are debiting J Young with 280, like we have said that this refers the wrong credit made to J Young's account. We are trying to restore his balance. Then we are now going to credit who? J Yates. J Yates. We credit J Yates with 208 as to correct. We are correctly reducing what? J Yates' balance. He returned the goods. So he returned the goods. We are correctly reducing J Yates' balance. That is how we are to record them. Hope we understand about that wrong transaction that we were to correct it. Because you know that Jayan's account is wrong as it was reduced incorrectly. So you must debit it to put it back. That is how we are correcting it. It was wrong because it was reduced incorrectly. So we must debit it as to put it back. Also, the J8's account is missing the entry. So we must credit him. So hope we understand each other. Now we are going back to, we are going to the last transaction. We're going to the last transaction, which reads as follows. Charge interest of 6% per annum for 3 months to have overdue account of K Pattern. He owes the business 6,800. He owes the business 6,800. So with this one, we are going to calculate what? The interest. We are going to calculate what? Interest. Whereby we are going to say interest is going to equal to 6,800 multiplied by 6%, which is going to give us what? 408 multiplied by 3 over 12, which is going to give us 102 as our interest. This is our interest. This is our interest. So we are to go and calculate it. We are to go and record it. So we are going to say, we are going to, we have what K pattern? We are going to have a K pattern. We are going to debit K pattern because we are adding interest to his account. So it increases what he owes. We are debiting him because we are trying by all means to add interest to his account, which is going to increases what he owes. So that is that. So it means our Theta's control, which is K patterns, is debited because the balance increases. So we are going to write it 102. And then we're going to have interest receivable. Interest receivable of where now we're going to credit 102. 102, which is the business earns interest, so it goes into interest income on the credit side. So the business is going to earn what? It's going to earn the interest income, which is going to go into the credit side. So that is how we are going to record it. That's how we are going to record it. So now we are going to move on to, so also we don't have to forget that under data's control, data's control there in our answer sheet on the debit side of our data's control, we have to write what? 102. This 102 supposed to be also under data's control. Indicate it here under data's control. So that's how we were to write it. So we are to make what? The totals now. We are to make what? The totals, data's, totals for data's control as well as creditors control. Data's control as well as creditors control. So that is that. Now we can even give the totals now, because there is a 1 mark that is given for totals, wherever we can say here is 1207. When you add them, then here you can have 2116. Here we are going to have 548. And then here we are going to have 348. So this is how we can leave the totals. Now we are moving on to question 3 now. We are moving on to question 3. Question 3. Here is our question 3. That we are to attend to it. That we are to attend to it. So the following information was extracted from the books of Nooks and Crannies Cleaning for the year ended 28 February 2023, and the business is 100% markup on cost. So we are required here, 3.1, complete and balance the following accounts in the general journal, February 2023. So we are first going to start by debtors control account. We are first going to start by debtors control account. This is now what we are asked to do. So Whenever we are talking about debtors control account, we are talking about what? That is, it shows how much customers owes the business. Shows how much customers owes the business. Owes the business. That is the debtors control account. How much customers owes the business. So on the debit side, when we do our debtors control, debit side increases what they owe. Credit side decreases what they owe. As you can see, when we are going to do it, we are going to do what? Debtors control account. So we are going to make sure that on the debit side, this is where by now it increases what they owe. Credit side decreases what they owe. Hope we understand on that point. So now we are to do what? Debtors control account. Let us go and see the information that we are given. Under 3.1, debtors control. Here is the information that we are given. So we want to see what debtors owe, how much the debtors owe the business. So we're going to see through this given information. We have cash receipts, cash payments, debtors journal, debtors allowance, creditors journal, creditors allowance journals. This information is going to help us to do what? To do debtors control, trading stock, as well as the stage now that we are asked to do. So now let us see that if we can see there, we have sales from debtors journal. We have sales from debtors journal. Customers did buy on credit from the business. If we can go under debtors journal, here we have sales of 12,800. It is going to go under the debtors journal. That is, it means that customers bought on credit. So they owe the business, they owe us more. As we're going to take ourselves as business, they owe us more. So it means that is going to increase our debit side. It's going to increase what? Debit side. Like we have said, debit side increases about what they owe us. So they owe the business this much because they were sold. There are goods that the business sold to them on credit by 12,800. It means you're going to record it under debtors controlled on the debit side. Take note of that. That is 12,800. Also, we have what? Let me see. All of this. As you can see, we want to see on the debit side of our debtors control, what else are we going to put? So we can see here under debtors allowance, there is nothing. You can see even under creditors journal, there is nothing. Also under creditors allowance journal, there is nothing that talks about the debtors journal on the debit side where it is going to increase more. So now let us go to, we have petty cash. There is where we have what? A petty cash. Here is our petty cash, debtors control. Here is our petty cash, which talks about what? Debtors control. So those are the small expenses like delivery charges that are paid on behalf of what? Of the debtor, fire petty cash. So the debtor now owes the money. So the debtors is going to increase on the debit side. So it means this is going to go on the debit side of our debtors control because it's going to increase our debit side as the debtors are going to owe us that money. So now we are moving on back to our question 3. So now coming to the credit side of our debtors control. Coming to the credit side of our debtors control. We can see that there was a discount allowed. There was a discount allowed on our cash receipts journal. If you can go to our cash receipts journal, here is the discount. We have what? Discount allowed. We have what? Discount allowed. So we gave discount, so we reduce what they owe. So it means debtors is going to decrease on the debit side. So this means it's going to go on the credit side of our debtors control. So that. Also, we have what? A bank under cash receipts journal. We have bank under cash receipts journal. Customers pay their accounts. We have bank under cash receipts journal. Customers paid their account. So we received. Once they pay, it means we receives. That is what debtors control. As you can see here, it is. So it means now as they paid, that is going to go on the credit side as well because of what? Customers pay the accounts, so the debtors is going to decrease on the credit side. It's going to decrease on the credit side. So that is that. So now let us go and record them on the answer book that is provided. So now let us go to the answer book now. Let us now go to the answer book and then do the debtors control. Here we are under debtors control account. So already we are given the balance brought down, it's given. General debits is also already given. So as we are to record what? The sales. Remember we talked about the sales? Sales from debtors journal, customers who bought goods on credit. We have said that is going to increase the debit side because customers, they owe the business more. So how much was the sales is what? 12,800. 12,800. It was from what? Debtors journal. DJ. Debtors journal. The customers, like we have said, customers bought on credit. So now again we have what? Petty cash, if you can still remember. Petty cash from the petty cash, which is PCJ, petty cash journal. Petty cash journal of how much? 208. So that is that. So also now we have what? Here on the credit side, we have bank and discount allowed. We have bank and discount allowed on the credit side. We have bank and discount allowed, which are all from cash receipt journal, CRJ. So there is a discount that was given to our customers of 270, if you can still remember. So also the customers did pay us through the bank. So all in all, when we add this, they added up to 4,550. So that is that. We were paid and there is a discount that we're given there under cash receipt journal, if you can still remember. So also we have what? debtors allowance. Debtors allowance. Debtors allowance. That is debtors allowance journal. DAJ of 1,200. Debtors allowances. So now we move on to like the debtors allowance journal that we talk about here is our debtors allowance. Also is going to go into the credit side of our debtors control, because it means it reduces the what debtors owes the business on the credit side. So it goes on the credit side. Debtors allowance journal. So that is that. So now we are going to balance. We are going to balance. So here is our debtors allowance journal. So of 1.2. Now we are to balance. We are to balance them so that we know that you are done with debtors control, and so that we move on to. So as we can see that our bigger side is this debit side, whereby now we're going to write the total amount of 38,740. Add them all, they will be 38,740. So we are going to write it both sides, 38,740. So when you add this side, it's going to give us a, it's going to give us 6,960. So we are going to subtract it from 38,740 to see how much it's going to give us, and then it's going to give us 31,780. 31,780, which is our balance brought down. Is our balance brought down for on the 1st of March. So our balance carried down. Here it will be our balance carried down. CD balance carried down, which is 31,708, which is on the 31st. And we can just write balance CD. So you can say balance, here you can say balance, then you're saying it's carry down. So now we are moving on to trading stock. We are now moving on to trading stock because we are done with debtors control. That is how we are to do debtors control. Now we are moving on to trading stock on question 3, because we are asked to calculate what trading stock. So here we are with our information. Here we are with our information under trading stock. Under trading stock. Under trading stock. So we have to look at this information that is given. So trading stock. A trading stock is an asset. Trading stock is an asset account that shows goods for sale. It's an asset account. An asset account that shows goods for sale. asset account that shows goods for resale. Goods for resale. That is a trading account. So now we are to come to this information and see how we are going to record our trading stock. So first we are going to look at our bank from cash payment. Stock purchased for cash increases stock on the trading stock. So let us go to cash payment journal. We can see here is our trading stock, which is 27,900. So it is going to go on the debit side of our trading stock, because stock purchased for cash increases stock on the debit side. Because when you buy a stock, it means we are increasing what our assets. So it increases what our debit side. That is that. Also, now we are looking for the information that is related to trading stock. Now we're going to have creditors control, that is cash journal. That is what creditors control. We are going to look at it where we are saying stock purchased on credit increases our stock on the debit side. So that is creditors control from our cash. So here we are saying what? We are talking about creditors control from our creditors journal. So if you can see here is our trading stock from our creditors journal. CJ of how much? Of 25,990. So that is a stock that is purchased. That is a stock that is purchased on credit. So that is a stock same as the one that was bought on cash, or that was paid by on check. Also, it is going to go on the debit side, because also it is going to debit side, because also that is going to increase on the debit side because of the trading stock. We are going to buy what is stock. So that stock is an asset. When you buy it, it means the debit side is going to be increased. So it can increase whether you buy it on cash or you buy it on credit. So remember, this one was paid by cash. This one is bought on credit. But because you are still paying for a stock, it is going to be received on the debit side. So hope it makes sense. Now also we are going to have what cost of sales on our debtors allowance journal. We're going to have what cost of sales of 600. Here it is. It also goes on the trading stock, because for us to sell stock, it means there are costs that we have incurred. So also it goes on the debit side. Goes on the debit side because the expenses are treated on the debit side. So debtors allowance, customers returns or debtors allocation, stock is put back. So this increased stock and debit trading stock. So it's divided on the trading stock. Also, we are going to have what? We are going to see if our petty cash is not affected. We're going to our petty cash. And here is our petty cash. And you can see that we have what? A trading stock. Here is our trading stock. We did buy a stock, taking out money from our petty cash. That is a stock that bought with petty cash. It increases our stock. Increases our stock on the debit side. So that is how much was it? petty cash. Petty cash, we have stationery of 280, and then supposed to be 380. 380. At this 380. So as we can see, these are all what we were to record under the trading stock. So now let us go straight to the answer book. Here we are on our debit, on our trading stock, in fact. So we are already given the balance brought down of 28,300. But if you remember on the 28, there was whereby we paid by cash when we buy the stock of 27,900. If you can still remember, that there is a stock that was purchased for cash. Also, there is a stock that was purchased on credit. If you can still remember, creditors control. So we are going to write creditors control, which is from creditors journal. This one was from creditors journal. This one was from CPJ, cash payment journal. How much was that one that we bought on credit? It was 25,990. 25,990. Also, still remember about what? Cost of sales. Cost of sales from DAJ, Debtors Allowance Journal, of how much? 600. So also the petty cash. We did buy our stock from our petty cash journal. Petty cash journal of how much? 380. Of 380. So there were donations that were already given on our answer book, but we are now to go to the credit side of our trading stock. I can see we are to go and see how we treat them on the answer. Here we are on our information. Then we want to see on the credit side, how are we going to record them? So cost of sales from debtors journal, cost of sales from our debtors journal, cost of sales from our debtors journal. Here it is 6,400. It goes on the credit side of our trading stock. So cost of sales from our debtors journal. Stock sold on credit leaves the business. Stock sold on credit leaves the business. So that is going to decrease the stock. That is going to decrease what? The stock. So it means that stock is going to leave the business. So it decreases on the credit side. That is why 6,400 is to go to credit side. Also, we are going to have what? Cost of sales from cash receipts journal. Cost of sales from our cash receipts journal, which is 22,000. As well, it's going to go on the credit side of our trading stock. So cost of sales from our cash receipts journal, stock sold for cash. Stock sold for cash leaves the business. So that decreases our stock. That decreases our stock on the credit side. That is why it goes on the credit side, because this is a stock that we sold on credit. So that is why we are saying cost of sales from cash receipts. That is a stock that sold, that is a stock sold for cash, then it's going to leave what? It's going to leave the business. Then it means our credit side is going to decrease on the credit side. Hope it makes sense to you. Also, we have creditors control from cash, creditors from creditors allowance journal, from creditors allowance journal. So if you can go to our creditors allowance journal, you can also see that we have what? A trading stock of 4,800. So stock is returned to supplier. So it decreases the stock. The business is the one that is now returning the stock to supplier. When you are saying it's creditors allowance. So it's going to be recorded under trading stock on the credit side. So this is how we are going to make our recordings. On the credit side, donations are already given. So here we are going to start by the cost of sales from debtors journal, as you have seen. Cost of sales from debtors journal. From debtors journal. That is a stock that was sold on credit, as we have said. That stock is going to leave what? The business. So it is going to decrease on the credit side. Also, now we are going to have what? Cost of sales again. This one, it was a cost of sales that is sold on credit. This is a cost of sales that now is sold on cash. That is cash received journal, CRJ. The difference is that this one was sold on credit, this one was sold on cash. The one sold on credit is 6,400. The one sold for cash is 22,000. Also, you remember we have creditors control. We have creditors control. Creditors control from creditors allowance journal. Creditors allowance journal, where we are returning our goods to our suppliers. That is 4,800. 4,800. So we are to balance them. As you can see here, we're going to get 3,170. 3,170. Then we are going to say, we're going to write March, then say 01, balance, wrote down, balance BD of 47,570. So here we are going to say balance CD of 47,570. So that is how we asked to do what? We are asked to do the trading stock. So the key rule under this trading stock, make sure that trading stock increases on the debit side. Trading stock increases on the debit side when we purchased or returned by customers. When purchased or they are returns by customers, it increases on the debit balance or credit debit balance, debit side. But it decreases on the credit side when we sold or returned to suppliers. So that is very important that you need to know or understand, because that will help you to make it easy when you are doing what? This debtors control, trading stock, and that. So now let us go and do what? Trade what? The stationery. Let us go and do stationery. As we're asked to do what again? The stationery account. We're asked to do the stationery account as well. So here is our stationery account. So stationery account is an expense account. Part of what? Of operating expense. Part of operating expense. It's an expense account. It's an expense account. An expense account or part of operating expense. So now we are to go under the information first. Quickly, let us attend to it. So we are going to look at let's look at the bank from cash payment journal. Cash payment journal. Here is our stationery. Cash payment journal. Here is our stationery. We paid cash for stationery expense. So we are going to, it's going straight on the debit side. We paid cash for stationery expense. So the expense increase on the debit side. If we bought the stationery, we paid cash, so it means we incurred expenses. So the expenses are treated on the debit side. That is that. Now we come to creditors control from cash journal. From, not cash journal, sorry. Creditors control from what? Creditors journal. From creditors journal. From our creditors journal. What we wanted to do is that here is our creditors journal. Do we have stationery there? Here is our stationery. Here is our stationery of what? 1,500. So we bought stationery on credit. We bought stationery on credit because it's a creditors journal. It means we bought stationery on credit of how much? 1.5. So the expenses increase on the debit side. So it is as well going to debit side because our expenses increases what? On the debit side. Remember that one we bought the stationery by cash, also it increases on the debit side. Whether we bought it on cash or on credit, but it is still going to go on the debit side of our stationery account. Also, now we want to see if whether we have a petty cash did buy our stationery by petty cash. We want to know if we did buy our stationery by petty cash. Very important. It's happening now. We want to know if we did buy our stationery on petty cash. Here we are. Here is our stationery. Here is our stationery of how much? Of 150. So we did purchase our stationery by through our petty cash account. We did take money from the petty cash and buy stationery of 150. Of 150. So it goes on the debit side. Goes on the debit side because it increases our expenses this day. So that is that. Now we are moving on the credit side of our stationery. credit side of our stationery. So creditors control from cash allowance journal. Not cash, but creditors allowance journal. We have creditors allowance journal, and we do have what? Stationery. Of how much? Of 175. Of 175. It goes on the credit side. It goes on the credit side. Because we are talking about creditors allowance, it means return stationery to supplier. We did return stationery to our suppliers. So when we return it, it means the stationery now is going to leave our business. So that is why it goes on the credit side. Hope we get it very well. So that is that. That is only what affects our credit side. Also, yeah, that is what, because we returned it. That. Then we have to look at other things that are related. So now that's all. Let us go and record it on the given answer book. Let us go and record it on the given answer book. Here is our stationery. So we first have to write what we are given. The balance brought down is already given. So remember, we did buy the stationery by cash. So we are going to say that is 28. We are going to say bank. CPJ paid it by cash of 1,620. Also, you're going to have creditors control. Creditors control, which is creditors journal. Remember, we did buy stationery on credit of how much? 1,500. Here we bought the stationery on cash. Here we bought the stationery on credit. We also did buy the stationery through our petty cash. Petty cash, which is PCJ, of how much? 150. So also on the 28th Feb, which is already okay, it's already there. We also have what? Creditors control. Creditors control of how much? Of 175. 175. We can write it in here. Creditors control. Creditors control of, which is from creditors allowance journal, CAJ. The goods that we returned cost 175. So now we are to balance it. Now we are to balance it. We are going to have 870. 870. Then much 01 total go down. It's 78. 7,895. 7,895. 95. 7,895. So now the balance total here, CD, balance carried out, that this CD is 7,895. So that is all. And then you get your 8 marks. So now we are to move on to other questions. We are to move on to other question. Under question 3. Three point two one. 3.21. It says the owner noticed that some debtors do not comply with the credit terms as part of their contractual agreement with the business. Explain the meaning of the concept credit term. So now you are to explain the meaning of this credit term. So the credit term is the length of time allowed to pay for goods and services that were bought on credit. That is that. So we can write it here where we are saying it is what? It is the length of time. The length of time. The length of time allowed to pay for goods. To pay for goods. Allowed to pay for goods and services. And services that were bought on credit. That were bought on credit. So that were bought on credit, which will include the number of installments as well as interest and exit. So this one provides two measures that can be implemented by the business to encourage early payments. Provide what? Two measures. Provide two measures that can be implemented by business to encourage early payments. That is whereby you are going to send reminders to your debtors. So you send reminders, for example, send SMS monthly statements. So you are going to send reminders. You send reminders. You're going to send reminders to your debtors, whereby now you can remind them about through the SMS about their monthly statements. Also, give discounts for early payments. Also, give discounts for early payments. Give discounts for early payments. 3.3 read as follows. The owner suspects that the stock has been stolen during the year. He has asked you for advice on internal controls he could implement to prevent stock from being stolen. List two internal controls for safeguard the stock. To safeguard the stock. So you are to list two, only two. Then we can say separation of duties. We talk about separation of duties. Can again talk about regular fiscal stock count. Regular fiscal stock count. Fiscal stock count. So these are what? Or stock must be kept in a safe place, can be as well, or hire security guards to monitor the warehouse. Also, he can as well purchase all purchases of goods should be properly authorized. So that is how we can try by all means to make what internal control to safeguard the stock. So thank you very much for your time. Make sure that we are going to use this presentation as a preparation for your coming exams. It will help you a lot. So make sure that you are going to share with those who are interested. Make sure that you are going to hit the subscription button. Thank you very much.